So I'd like to welcome you guys back out to everybody's favorite market commentary. We have the news you can actually use. Nicholas Conti is always representing King Visions FX, and today we want to try to shape the picture of the potential for the change in market conditions. Now, commodity prices from copper to wheat are collapsing, and that could flip global inflation into deflation. You guys may say, hold up, stop the tape. We recently, as a matter of fact, we actually got a CPI print of 9.1. You may say, hey, Nick, that's definitely inflation. It's still rising. Well, one caveat to that, and what I'll say in response is, good thing that the CPI is a lagging indication. Now, to kind of unpack this a little bit, we had inflation from market pundits. We had a mass hysteria. We got all hands on deck from the Federal Reserve. Their main mandate now is to fight and kill inflation, no matter what consequences they're actually starting to see with the labor market or the economy. So the more that the Fed actually hikes, the higher potential for a global recession or a recession that was already built upon a global slowdown. So deflation does make sense. Let's hit a couple of these bullet points. Global inflation is likely to swing to deflation within the next 6 months. Our timeline may even be a little sooner than that. We're starting to see reaction in things like the oil market, pretty much all commodities. There is a index that we track that is a basket of commodities. We're starting to see that pull down into a bearish structure, as well as the copper market already in bearish context. Now, the bank says such a deployment would follow what has been a fast collapse in commodity prices. Just last month, everybody was such bulls. No one felt that the commodity could come out the sky. Now, this is normal in market environments or in different cycles we see in the market. You usually have stocks or you usually have bonds, then stocks fall, then we get into commodities. Now, for the end user or consumer, what that gives us is discounts. We have potential to buy in at a cheaper price and actually take advantage of market fluctuations. Now, agriculture prices have been a part of the route as well. I've also seen copper and oil prices yanked lower. So all hands on deck again from the Federal Reserve, with them actually raising rate. It's going to suppress or make money a lot more expensive to borrow. So we're definitely going to be looking for that dreaded R word, which is going to actually reflect and help bring out some of this price deflation. Now, this economist did give us a little bit more context for time's sakes. We won't dive too deep, but one huge thing that he did point out was oil prices this last year were between $70 and $80. So it doesn't take much of a fall from here. We're currently at 95, despite most people thinking this, or most pundits saying it was going to go to 200. We're now back around 95. So 70 to 85 wouldn't take too much of a fall to get into a year over year deflationary environment. That'll give us a relief on everything from the pumps to transport. The oil starts the catalyst. Now, we do track this data in detail when we start with places like China, and we kind of just watch the global trade to give us an understanding which stocks, which currencies, which places in the bond market, which cryptos we would like to trade. So if you guys find this information valuable, hit that like button, share, comment, let us know what you guys want us to speak about, and we'll see you in the next video.